Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
Even in a deflationary environment, that is when gold tends to provide the most cover.
What do you think the Fed will be forced to do, or how will they react to all of this?
So they're getting close to where I started the year with kind of my highest conviction call that it's material that Canada and Mexico are going to be slammed into recession.
Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas, and today I am honored to invite Danielle DiMartino Booth to join me to talk about the current state of the U.S. economy, where it's been over the last 3-4 months since Donald Trump was elected and now inaugurated, and also where we think we're going to go now that the tariffs have been enacted. And one of the reasons I admire and respect Danielle so much is she has her finger on the pulse of the U.S. economy more than just about anyone I know, and not just the artery or the veins, but all the way down to the capillaries, where the oxygen goes in and the carbon dioxide comes out. So Danielle, thank you so much for being here today. It's wonderful to be here with you.
Likewise, thank you so much for having me. I'm excited that you're doing this.
Well, my pleasure. So my first question is, what is your baseline for the U.S. economy over the last 3 to 4 months? What trajectory have we been on, so we can kind of get a status of where we've been and where we're headed before the impact of all these tariffs hit? So what have you been seeing?
And I think that's a critical question to ask because as I always say, as you know, starting points matter. And from everything that we've seen, the prior administration, kind of their back padding was a little bit premature. We've seen some materially large downward revisions to payrolls going back well into 2024 from what was originally reported. And just by way of a little bit of background, every quarter the census requires U.S. employers to provide their actual headcount numbers. So if you will, that's about as hard as the data can ever get compared to what we would call soft survey data. And from everything that we're seeing, it looks like payroll losses probably began in the spring of 2024. It takes a very long time for these revisions to be reported, but it definitely looks like the U.S. economy was in recession prior to these tariffs being imposed. We've seen that in layoff announcements. We've certainly seen that in the explosive growth of the gig economy. Ask your Uber driver how long they've been driving. You'll probably be surprised by their answer. And I think that's one of the things that distinguishes the current cycle from the Great Recession, 2007, 2008, leading up to 2009, is that back in those years, there was no gig economy as we know of it today. Uber was born in Paris in 2009. So rather than see a dramatic rise in initial jobless claims, which we all watch on Thursday mornings, we've instead seen millions upon millions of American displaced workers flow into the gig economy. And that's one of the reasons that we haven't seen any kind of pronounced increase in the unemployment rate yet. But I would say yet, because what we're finding now is that the law of supply and demand, there's a lot more supply out there than there used to be of gig workers. And lo and behold, weekly Uber earnings, income for drivers has been falling. So it looks like we're going to continue to see what we saw this last week with 1.9 million Americans continuing to collect unemployment benefits. That's a post-cycle high. And again, that's where we were before the tariffs kicked in.
So what you're saying is if the U.S. economy employment was a balloon, it's been leaking for about a year now, right? But it's kind of hard to measure because some of that air has been going into other smaller balloons.
That's exactly right. That's a great analogy to use. That's even better than your capillaries. But yes, the U.S. economy has a huge kind of a cushion underneath it that we haven't had in prior cycles. So it makes comparing the cycles a little bit more challenging. But it also puts the onus on the Federal Reserve and Federal Reserve officials to have to pay attention to more real-time indicators to take the pulse of the U.S. job market, because in addition to their inflation mandate, the Fed continues to have a labor mandate and to maximize employment while its other goal is to minimize inflation.
Well, doesn't the Fed notoriously look in the rearview mirror instead of in the, out the side mirror or even the front mirror or the front windshield rather? Right?
Yeah,
You worked for the Fed for years at the Dallas Fed.
reminds me of the little old lady driving in the old Wendy's commercial saying, "Where's the beef?" looking over the steering wheel because she can't see. And that's kind of how the Fed makes monetary policy. Very much in a way that they're backward looking. They're looking at lagging indicators. That's especially the case with inflation metrics. We've seen real-time measures of inflation come down appreciably this year. And that goes right along with the fact that on an inflation adjusted basis, we've seen average weekly earnings fall since September. So it makes perfect sense that if incomes have begun to decline, then Americans can afford to spend less. And that therefore you would begin to see that flow through to real-time inflation metrics. That's exactly what we've seen. We've got Trueflation, TRU, at 1.39%. So that's come down appreciably from 3% just a few months ago.
So despite some of the stickiness we're seeing in the CPI, headline and core, and the PCE, which is a little weaker, inflation you think is actually going to continue to diminish because of a lack of demand?
Well, more so because of a lack of purchasing power. So when you have somebody coming out of a full-time job, and we know that full-time job creation peaked in 2023, and that means that you've seen more people flow into the part-time job sector. And what that means is your paycheck is getting smaller. So, you may still have the desire to purchase things, especially of a discretionary nature. But if your paycheck will only cover the rent and essentials, and maybe not even that much, right? We've just learned that a record 17% of existing home sales in 2024 were to multi-generational households. And that, again, is reflective of the fact that so many individual U.S. households cannot afford to set up house and home on their own paychecks alone, and that they're actually having to bunk up with their parents, or parents are having to bunk up with their parents if they can't afford to put them into nursing homes or assisted living, where we've definitely seen inflation completely off the rails in the post-COVID era.
Okay, so let's talk about business a little bit, because you educated me recently in one of your quills, your daily and your weekly postings, that business investment tends to lead the economic cycle more than we would think consumer spending, which is 70% of the economy. So what have you been seeing with business and private fixed investment over the last couple of months?
So there was a big burst of enthusiasm and optimism immediately following the election. I think a lot of small business owners, large business CEOs, CFOs were hopeful that the deregulation impulse and the idea of lower taxes would flow through to how they conduct business in a more rapid manner. And we've seen a full reversal of that optimism. And in fact, we've seen capital expenditure planning go into contraction here just in the months of February and March. So a lot of the exuberance, if you will, has been wrung out of the system, and we're starting to see companies plan to disinvest. And as you said, research that the Dallas Federal Reserve conducted in 2024 demonstrated that in 3 of the post-war recessions, we actually had increasing consumption throughout recessionary periods. So it's not unusual to see consumption hang in there, even as business investment declines. But to your point, it is business investment that leads the cycle, business investment that leads the U.S. economy into and out of expansions and contractions.
And businesses are increasingly challenged these days, right? Because of rising input costs and more difficulty to pass those cost increases through to the consumer. Would you elaborate on that a little bit, please?
So I think that it's something of a red herring that so many in the media are falling back, as well as the sell side, are falling back on it's stagflation. from 1975 until 1979, we had a backdrop in the U.S. economy where the level of employment was rising, and thereby the oil shock that was pounding the economy at the time. But again, against the backdrop of rising employment, companies were able to pass through those higher costs of oil, pass through those higher costs of gasoline. I remember as a very young girl sitting in line at a gas station with my mother. So at the time, while Americans didn't like paying higher prices, the fact that their paychecks were growing allowed them to do so, and therefore stagflation set in. In the current environment, what we're seeing is companies increasingly bemoaning the fact that they're having to shoulder higher input costs, but they're not able to pass those through to the end consumer, again, because employment is declining, incomes are declining. So that is what we call not stagflation, but we would call that a margin squeeze. And that's one of the reasons that you're seeing Wall Street dramatically, as they are, take down earnings expectations for the first quarter. We've seen that number come down appreciably since the end of 2024. And that is reflective of the fact that if companies cannot pass through those higher input costs, it's going to come straight out of their bottom line.
So how do companies cut costs if they need to cut costs?
Well, cutting costs is it's a polite euphemism for job cuts, in the same sense that when you see two companies merge and they announce that there are synergies between them, two of the largest mortgage companies in the United States merged just a few days ago. Well, guess what? After the merger is completed, they will realize these quote unquote synergies by cutting headcount by quite a bit. In that same spirit, when companies are in cost-cutting mode and trying to protect their margins, especially if you're answering to shareholders, then the solution is to cut costs by way of reducing your biggest input cost, which is labor.
Labor, the biggest input cost. So that's how they cut, right? There's no cutting margins when they can't. So, and that's why you wrote in Tuesday's Quick Quill, tariffs may dominate today's headlines, but risks for an abrupt weakening in the U.S. labor market continue to build.
Yes, and that's exactly right. In fact, when you look at the combination of the magnitude of the increase in higher unemployment expectations expressed through the University of Michigan and perceptions that there will be fewer jobs through the separate but also very established Conference Board Consumer Sentiment Survey, when you combine the two of those surveys, which we did in proprietary research, in order to gauge what the labor shock would be, what we find is that as of March, we should see an unemployment rate that is 4.3%, and that by September, again, given the magnitude of households' perceptions of the deterioration of the labor market, historically speaking, we should see an unemployment rate at 4.9% by the time we get to September.
Right. So that's 4.9% by September.
That is what we are modeling out right now. And it is indeed what we're seeing with the magnitude, again, of the layoffs that are being reported, not just in the public sector by way of the Department of Government Efficiency, but also in the private sector.
And this is before tariffs.
That's exactly right.
Okay, so let's segue into tariffs. Yesterday's announcement of tariffs across the board, much higher than most analysts anticipated, was a real shock to the system. We've seen markets across the board in Asia down 0.5% to 1% on average overnight, Europe 1% to 2%, but the U.S. got absolutely hammered today, down 3%, 4%, and 5% on the major indices, and the dollar down 2% on the U.S. dollar index, which is a huge decline. How do you see tariffs impacting a U.S. economy that's already weak due to business investment declines, higher unemployment already, margin squeeze with business? How do you see this translating?
So first of all, let's contextualize the litany of market moves that you just mentioned, only because a client of mine put it into perspective for me. So when you see oil prices down 5% and a major stock index like the S&P down 3% and the dollar down 1%, to say nothing of the 2%, in 42 years of history, there's only one precedent, and that was the flash crash of 2015. So we've only seen markets move in concert to the degree that they are one other time in the last 42 years. And the reason that markets play so critically into how companies are going to proceed in a post-tariff world is because a recent study by Moody's found that the top 10% of earners accounted for 49.7% of U.S. consumption. So consumption has never been as concentrated in the hands of the few as is the case today. So while we like to repeat the mantra that the stock market is not the economy, the very real reverse wealth effect could indeed have real economy impacts in the form of reduced consumption. In fact, in the most recent surveys that we've seen, expectations for the future have been declining at the most rapid pace among the highest earners. And that's not good news for the real economy. Then you start to talk about something beyond a margin squeeze. You start to talk about not just impairment with the bottom line, but impairment with the top line, with revenues. And revenues are not something that companies can plan for. They're not something that companies can answer for. They do put them into a much more aggressive cost-cutting mode when top lines get hit. And I fear that that's what's coming, because these types of trends, when they begin to unroll in sync, in concert with one another, that's when you really start to see a feedback cycle of sorts, where where rising unemployment begets even more rising unemployment. And this is kind of the fire, if you will, that Donald Trump is playing with. It's the United States does not and will not ever exist on an island. It's material that Canada and Mexico are going to be slammed into recession, to say nothing of many of our trading partners. When you think of the 34% tariff placed on China, Japan wasn't too terribly far behind at 24%, and Europe at 20%. So the globality of the recession is going to be very impactful in the United States. We've seen an absolute collapse in inbound international travelers to the United States as animosity grows. And that goes to show you how politics can play into the real economy. So, it's a very, very uncertain future going forward. And I think that today's price action notwithstanding, that's one of the reasons that we've seen this rush into gold, because when correlations among most asset classes line up and you're losing money in most places in your portfolio, even in a deflationary environment, that is when gold tends to provide the most cover.
Right. Well, gold is actually performing quite well today, considering the carnage that's happening in markets across the board. But it's unusual to see the dollar get hit so hard in a time of stress, because usually the dollar becomes safe haven because money from abroad wants to come into our markets for safe haven. But that's clearly not the case. So the U.S. economy is not already in a pretty picture. It's weakening. And now the tariffs are going to accelerate that into a bit of a snowball effect, is what you're saying.
Well, and again, over the years since China entered the World Trade Organization in 2001, the more imports that U.S. companies and consumers have purchased, the more dollars land in the coffers of foreign countries, especially China. And that tends to be put back into the U.S. economy in the form of purchases of our treasuries. And if that's not going to happen, if they're going to be selling fewer products into the United States because those increased costs, those tariffs cannot be shouldered and much less passed through, then there are going to be fewer dollars that are filtering out to then be rotated back into fresh treasury purchases.
So that weakens the dollar.
Well, that's certainly the reaction that we're seeing today.
Right, which is highly unusual. So, we've talked about, economists have talked about the period of U.S. economic exceptionalism where we've outperformed most of the rest of the world for the last 2 years. And that's clearly coming to an end now because of this, is what you're implying, I think.
It is, and there's also something to be said for what I would characterize as the overinvestment many of the largest Silicon Valley companies have made in artificial intelligence compared to other countries. When you see news come out that AI can perhaps be produced much more cheaply, much more efficiently. Maybe there's been one too many data centers built in the United States. For heaven's sake, last year I think there were 5,500 data centers in the United States and only 500 in China and 500 in Germany, just to give you some context. So no, I think that there's a lot of rethinking of some of the exceptionalism that we've been talking about for years now. And you especially shine a light on that when markets begin to falter, because as the saying goes, valuations don't matter until they do.
Well, clearly the global economic activity is going to become more nationalistic now. The last time President Trump enacted tariffs, we had rivers flowing with goods from here to China and vice versa. When those tariffs from 2017, 2018 came in, it was like the rivers got dammed, but the water still went places it wanted to go. Like factories came up in Vietnam and Mexico so that China could avoid the tariffs directly. So how do you see all of this impacting? Is the U.S. really trying to become an island now? Is that what Donald Trump's trying to do? You said in an interview on Bloomberg the other day that, factories don't just pop up overnight. So we're going to go through this rough patch, it feels like, till we can get to some of the pain, get through the pain to get to some of the gain that he's trying to accomplish. Do you think that's possible?
Well, I mean, I think one of the disappointing factors yesterday was that there were fewer fingerprints of Treasury Secretary Scott Bessent on the tariff announcement. And I say that because he was of the very sober philosophy that if there was going to be a carrot and a stick, then you should at least give U.S. companies a lot of runway, a lot of time to reshore, and to say nothing of the fact that that you can't penalize companies for the investments that they've made in what we would call friendshoring in recent years. In other words, say, oh, gee, that factory that you built in Mexico is overnight a sunk cost. That just doesn't fly. That's not how businesses are run. And I don't think the U.S. government can force a business to operate that way. One of the more interesting responses that I saw to the Dallas Federal Reserve manufacturing survey a few days ago was from one company. These are, of course, all anonymous, that said, I'm thinking of closing my doors. And this was a viable entity. But again, in order to make business work, you have to have the ability to forecast profits and cash flows. And if that's not the case, then you're actually going to see a shrinking footprint and fewer jobs created. So I would like to think that they're giving more thought and time to our relationships, our trading relationships with Canada and Mexico, because they're trying to be more thoughtful in the approach, such that all of these investments in friendshoring will not have been for naught. But boy, did we see countries like Vietnam really take it hard in terms of the punitive level of tariffs, which, to your point, Dana, was a very direct communique to U.S. companies, to corporate America. When we say bring it back home, we don't mean, take it across the street from China.
Yeah, well, Nike was down 13% at one point today because half of their products, their sneakers, are made in Vietnam. And so is Lululemon, and Apple's getting hammered in China but they make products all over Southeast Asia. So speaking of the carrot and the stick, I've talked to a couple of my colleagues over the last couple of weeks, primarily about precious metals and how they might be affected by tariffs, which they've been exempted, thankfully. But they've all come to the same kind of conclusion, and it makes sense to me. Is this the stick now? So the carrot comes to us where the tariffs get dropped in 3 months or 6 months and everybody gets a level playing field. What do you think the possibilities of that are? I mean, I know there's been a lot of uncertainty, and they were going to put them on a month ago and then they take them off, and now they've been enacted and across the board. How much of this is really just a negotiating tactic to get a more level playing field to help the U.S.? Do you think that's a possibility? What are your thoughts on that?
So, I was listening to Commerce Secretary Howard Lutnick in an interview this morning on Bloomberg, and he was fairly flippant in saying, if China wants to stop manufacturing fentanyl and sending it to U.S. shores, it's a simple matter of picking up the phone, and that 20% tariff would disappear overnight. I bring up that example because I think that these tariffs are in some ways a negotiating tactic, and that we could end up having an individual country by country approach to the tariffs. And in fact, several countries have already reached out to the White House, in the immediate aftermath of these tariffs being imposed. My only comment would be that this is it's an interesting way to go about trying to reshape, if you will, the global economy. And that appears to be the overarching goal, kind of this idea of making America great again when it's the world's largest economy. But I certainly understand the idea of the loss of manufacturing jobs in the past several decades, and the idea of bringing manufacturing back onto our shores. But again, I think that we're going to need in the coming months a much more well thought out and communicated motive on the part of the White House and President Trump's cabinet to have more certainty going forward. Because for heaven's sake, the tariffs in the actual communique, they're presumably going to end. I think the verbiage was somewhere along the lines of when things improve, which is about as nebulous as you can possibly get.
Right. Well, everyone likes some certainty, and that's been the biggest word that has been used over the last couple of months: uncertainty. So we're going to run out of time in a little bit. So let's get to how this is going to play in your favorite ballpark with the Fed. What do you think the Fed will be forced to do over the next 2, 3, 6 months? You've said that we might get cuts as early as May, which I think is premature, but you're the much more highly educated expert. What do you think the Fed will be forced to do, or how will they react to all of this?
So even before the tariffs were announced, I was of the mind that the Fed was going to be forced to cut on May 7th, simply because of the economic calendar. May 7th is a fairly early meeting on the calendar in May, and yet we have a GDP report coming out on April the 30th, just a week before they meet. And then we have April non-farm payrolls being reported on May the 2nd. So given the magnitude, just the magnitude of the layoffs that have been announced this year, I would be shocked if we didn't have an unemployment rate, which is currently 4.139% prior to March payrolls being reported. But it would be a shock to me to see that 4.139% not increase to 4.3, 4.4% by the time we get through two more jobs reports, again, that predate the Fed's May the 7th meeting. And again, I go back on the fact that almost half, 49.7% of consumption is attributable to the top 10% of earners, while the Fed may not say that they react to the stock market. If we do see a sudden abrupt arrest in consumer spending, that is something that the Fed's going to have to pay attention to.
So perhaps more or sharper rate cuts than we have been baking into the cake so far?
Well, Goldman Sachs came out a few days ago and raised their expectations to 3 rate cuts this year. So they're getting close to where I started the year with kind of my highest conviction call that the Fed would be cutting rates 4 or 5 times in 2025. While it was seen as heresy at the beginning of the year, the market is certainly a heck of a lot closer to where I am as we speak today.
Well, you've always been a little bit ahead of the pack, Danielle. That's why we like you, and that's why we respect you so much. What about the potential for QE?
Ah, well, I think that QE, for many reasons, is going to be a much more difficult proposition. Uh, for starters, we've never seen QE launched by the Fed when the federal funds rate was not at the zero bound. In fact, most inside the Fed believe that's a prerequisite. We're still in the process of shrinking the Fed's balance sheet, though that process has been tapered back to $5 billion a month of roll off of their Treasury portfolio. But that certainly is not the case with the $35 billion in mortgage backed securities roll off that they have said will continue. And in fact, the New York Federal Reserve blueprinted the roll off of mortgage backed securities from the Fed's balance sheet through the end of 2035 last year. So even though that's been much slower to take hold than it was before, I would say that with the benchmark 10-year yield approaching 4%, we're going to see a pickup in mortgage prepayment speeds, and that could accelerate the Fed's quantitative tightening. Again, most Fed officials right now, and Jay Powell's got just over 12 months left in his term, which ends in May of 2026. But none of the Fed officials we've heard from have advocated for going lower than what they consider to be the neutral rate with the Fed funds rate. And all of those are centered in the 2.5% to 3% range, meaning I think the idea of discussing quantitative easing with the prerequisite that the Fed funds rate be at zero is a little early on here.
Yeah, okay, I'm getting a little ahead of myself. But so you think the Fed funds rate could end the year 2.75%, 2.75, somewhere around there, which would be pretty sharp cuts from where we are today. And
yes, I think we could certainly be much closer to 3% than the 4.25% where we are today, potentially even below the 3% mark. Again, depending on how quickly the unemployment rate rises. And what we've seen historically, and what most people on the sell side want to deny, is that once the unemployment rate becomes unhinged, it does not tend to move up in a polite fashion, 1/10 here, 1/10 there. It tends to gap up once it becomes unhinged historically. And, unless, of course, this time is different.
Well, that has proven to be not the case, and almost every time that has been uttered before. Right. So any advice you'd want to give to people on how to defend themselves from a weaker economy or the increased cost inputs and margin squeeze companies are going to go through with tariffs? How would you be positioning yourself?
So, kind of on a very personal level, I would say that you need to have a pretty good, tight control of your day-to-day budget, of your own operating costs as a household. And to the extent that you are exposed to the stock market, I would be pretty darn sure that you had an income stream attached to those stock holdings. In other words, investing in companies whose dividends were absolutely locked, tight, safe, perfect, and in no way threatened with a dividend cut. So you use the word defend. I would say that being defensively postured right now is prudent. And indeed, we've seen a massive rotation this year into more defensive areas of the stock market. And until my prediction comes to pass, you still make a nice 4% return on your cash, which, it wasn't but 5-6 years ago, would have been kind of extraordinary to investors. So we shouldn't have short memories, and we should, behoove the indirect advice of Warren Buffett, who's still sitting on record levels of cash. So I like to say, if it's good enough for Warren, then it's good enough for me.
Okay. Well, on that, I would like to say thank you very much for joining us today and appreciate your time. Your currency, your stock today is hotter than a company that makes products in the U.S. with all the data that's happening and everything that's going on. So thank you so much. It's great to see you. We'll look forward to seeing you on Fox News and on Bloomberg. And of course, I love to get both my daily quill and my weekly quill in my inbox. I'm a subscriber. And I encourage people, if you have not been exposed to Danielle's research, you should go to quillintelligence.com to learn how you can subscribe or see some of the information that's already there. So thank you so much, Danielle, and good luck out there today.
Thank you so much. I appreciate your time as well.
Thank you.